Welcome to the deep dive. Today we're digging into General Dynamics, specifically their third quarter 2025 results. That's the period ending September 28th.
Right, and what we've pulled from their latest filings, it paints a really interesting picture.
Yeah, it seems like on one hand, the company's just hitting it out of the park operationally, setting
It's
records.
absolutely dominating core metrics, but there's a but.
There usually is. They're also facing some pretty significant external risks, things that management really can't control.
Exactly. But let's start with the performance because, wow, the consolidated snapshot Q3 this year versus last year, pretty spectacular.
Give us the headlines.
Okay, so revenue hit $12.9 billion. That's up 10.6% year over year.
Solid growth.
And diluted EPS, earnings per share, that shot up 15.8%, came in at $3.88 per share.
Okay, so strong top and bottom line growth. What about profitability itself? Margins.
Also good news there, operating margin expanded by 20 basis points. It landed at 10.3%.
Right, and just a reminder for listeners, a basis point is tiny, 100th of a percent. So 20 of those across a company this size, that signals real efficiency gains.
It really does. But the core story, I think, the thing that really underpins all this, it's demand.
The order book.
Yes. The company statement specifically mentioned very strong order activity in all four segments. No ambiguity there.
And the key metric we look at for that is the book-to-bill ratio.
Exactly. And for the quarter, consolidated, it was 1.5 to 1.
1.5 to 1. So for every dollar they actually billed out as revenue, they booked $1.50 in new confirmed future work. That's just feeding the pipeline aggressively.
Relentless growth, like you said. And that strength, that operational power, it flowed right through to their financial health. Cash flow was, frankly, stunning.
Okay, tell me about that. What was the standout number?
Net cash from operating activities, $2.1 billion for the quarter.
$2.1 billion. Okay, strong.
But here's the kicker. That represents 199% of their net earnings for the same period.
Wait, hang on. 199%. So they generated nearly twice the cash from ops as they reported in profit.
Almost double, yes.
How does that work? And why is that figure so significant, especially for a big defense contractor like GD?
Well, it speaks volumes about their working capital management. Think managing inventory, getting paid by customers quickly, paying suppliers efficiently. They're not just making paper profits.
Right.
They are converting those reported earnings into actual cold, hard cash at an incredible rate. And that $2.1 billion in cash flow, that's the bedrock. It lets them handle shocks, invest long-term, manage debt.
Okay, that makes sense. So let's dig into that foundation a bit more. Section 1. It's the massive demand and cash picture. The forward visibility seems huge.
It really is. The commitment numbers are just staggering. You look at the total backlog first. That's the confirmed funded contract.
Oh, yeah.
That hit $109.9 billion. Just shy of $110 billion.
Wow. And that's up how much?
18.6% from last year. Significant growth.
$110 billion is massive. But I remember seeing an even bigger number when you include potential work.
That's right. The total estimated contract value, that includes things like options on contracts and those IDIQ contracts, indefinite delivery, indefinite quantity.
Right, the flexible government contract.
Exactly. When you add all that potential work in, the figure jumps to $167.7 billion.
Okay, so over $167 billion in total expected work lined up. That's years of revenue.
It absolutely is. And they gave some color on the timing, too. They expect to turn about 45% of that remaining obligation into actual revenue by the end of 2026.
Just 2 years out.
Yep. And another 30% by the end of 2028. So for you, the listener, think about that. We're talking maybe 7-8 years of guaranteed work already essentially locked in.
That kind of visibility must be a huge comfort for management and investors. And it links back to capital, right?
Yeah.
How did free cash flow look?
Very healthy. For the first 9 months of 2025, free cash flow was $3.007 billion, just over $3 billion.
Okay, strong cash generation. But what about the other side of the coin? Debt.
Good question. They do carry debt. Net debt, that's total debt minus their cash reserves, ended the quarter at $5.494 billion. Call it $5.5 billion.
Which sounds like a lot, but
you have to frame it. Compare that $5.5 billion in net debt to, say, $3 billion in free cash flow over just 9 months, or nearly $13 billion in revenue in 1 quarter. It shows they're leveraged, yes, but the cash flow means they can handle it quite comfortably.
makes sense. The cash flow supports the debt load. And speaking of confidence in cash flow, the dividend.
Ah, yes.
Yep.
Can't forget the dividend. They increased it back in March 2025 up to $1.50 per share.
And wasn't that part of a long streak?
It was indeed their 28th consecutive annual dividend increase.
28 years. That says a lot about their long-term view on cash generation, doesn't it? Whether it's coming from, the Pentagon or from private jet buyers.
Absolutely. It signals deep management confidence in the underlying business model.
Okay, well, let's talk about those private jet buyers then. Section
Right.
2, aerospace. This seems to be the star performer this quarter. General Dynamics commercial aviation arm, mostly Gulfstream.
Oh, absolutely. It was an exceptional quarter for them. Really drove the overall company margin expansion.
What were the numbers?
Huge jumps. Aerospace revenue was up 30.3%, hitting $3.234 billion.
Over 30% growth. Wow.
And operating earnings grew even faster, up 41.0% to $430 million.
41%, and that explains the margin lift you mentioned earlier.
Exactly. That drove a full 100 basis point expansion in the segment's operating margin, took it up to a very healthy 13.3%.
And was this just more planes going out the door? Volume driven?
Pretty much entirely. Aircraft deliveries jumped significantly. They delivered 39 business jets in Q3 this year compared to just 28 in Q3 last year.
Okay.
And that surge, particularly in aircraft manufacturing revenue, up $630 million from the prior year quarter, was mostly down to delivering more of the new G700 jets.
Ah, okay. So that big new program, the G700, is really hitting his production stride.
Seems like it. But what's also really interesting is their product strategy. There were two kind of aha moments or key milestones this quarter that show where they're headed.
Okay, like what?
First, they delivered the very first G800. That's their new ultra-large cabin, super long-range jet. That happened in August.
Right, the G800. Wasn't that replacing a really successful model?
It is. It's a successor to the G650, which was, legendary in that space. They actually delivered the final G650 back in Q2.
So delivering the first G800 just a couple months later. That's a smooth transition at the very top end of the market.
Very smooth, high-value transition. Keep the momentum going.
Okay, what was the second big product news?
In September, they announced an all-new jet, the G300. This one's in the super midsize category.
G300, and that's replacing another model too.
Yes, it's slated to replace the G280, which has been a very popular plane in that segment.
So G800 at the top, G300 in the super midsize. It sounds like they're actively refreshing the whole lineup.
That's exactly the point. They're not sitting still. They're making sure they have the latest tech, best fuel efficiency across all the key market segments, keeping ahead of the competition.
And strategically, how did they achieve that nice 13.3% margin in aerospace? Was it just volume?
Volume helped a lot, but the filings also noted something else. Lower G&A general and administrative costs and other expenses.
Why was that?
Mainly because R&D spending came down. The big spending associated with getting the G800 certified, that's largely done now.
Okay. So they absorbed the heavy research and development costs, got the plane certified and delivered.
And now they start reaping the rewards with higher production volumes and lower R&D burden on the income statement. That's the payoff.
Makes sense. What's their outlook for aerospace for the full year then?
Management guided for full year 2025 aerospace revenue to be around $13.2 billion, with that strong 13.3% margin holding. It's a real engine for them right now.
Okay, a powerful commercial engine. But GD is still fundamentally a defense giant. Let's move to Section 3, the Defense Corps. Starting with marine systems.
Right, shipbuilding. And they saw strong growth here, too, actually. Revenue up 13.8%, hitting just over $4 billion for the quarter.
$4 billion from shipbuilding. What's driving that growth?
It's primarily the nuclear side. Increased construction volume on the big submarine programs.
So Virginia-class attack subs and the new Columbia-class ballistic missile subs.
Exactly. Those are huge, multi-decade programs demanding incredible industrial capacity, and GD is at the heart of it.
And their order book in marine, still strong.
Yep. Solid book-to-bill of 1.2x. They're locking in more long-term work. Key awards this quarter included another Arleigh Burke-class destroyer, the DDG-51.
A workhorse for the Navy.
Absolutely. And also about $640 million for design work and lead yard services for the Virginia-class subs. Stable, long-term government funding.
But I noted the margin in marine systems was quite a bit lower than aerospace, only 7.1%.
That's right, 7.1%.
Given the huge revenues, over $4 billion, is that margin considered?
Okay.
Or is it a point of concern?
It's definitely lower, and it highlights the challenges in shipbuilding right now. It's not easy to just, ramp up production quickly on something as complex as a nuclear submarine.
What are the specific headwinds?
The filings point to ongoing challenges with getting a relatively new workforce fully up to speed on some really complex tasks.
Yeah.
That impacts efficiency initially.
Training takes time.
It does. And they also mention persistent supply chain issues. Getting all the parts needed on time from potentially thousands of suppliers is still a challenge that affects costs and schedules. So they're investing heavily to meet the Navy's demand. But that investment puts temporary pressure on the margins.
Okay, understood. It's a context thing. Let's shift gears to the other big defense segment, combat systems.
Yeah.
It's tanks, vehicles, munitions.
Right. And here the story was really about booking new orders, reflecting, the current global security environment.
How strong were the orders?
This segment had the highest book-to-bill of the whole company this quarter, a massive 2.0x.
2.0, so
Right.
$2 in new orders for every $1 billed out.
Exactly. That's not just a number. It's a direct signal of, global rearming efforts and restocking. GD is clearly benefiting.
What were the big contracts driving that huge number?
Well, first, a huge $1.7 billion chunk was for munitions, ordnance, and propellant. That speaks directly to usage rates and the need to replenish stockpiles worldwide.
Makes sense. What else?
They also got a $595 million contract for engineering services on the next-generation Abrams tank program, securing the future of that key platform.
And I think there was some notable international business, too, not just the U.S.
That's right. A significant order came from Latvia, about $365 million for ASCOD combat vehicles and training.
ASCOD, that's an infantry fighting vehicle.
Yep. It shows how NATO countries, even smaller ones, are actively upgrading their ground forces, which provides another steady stream of revenue for GD outside the U.S. budget cycle.
Okay, so huge orders overall. But wasn't there a contrasting point in the data, something about U.S. vehicle revenue declining?
Yes, that's true. While the future orders look massive, actual revenue recognized from U.S. military vehicles did decrease in the quarter,
Why was that?
partially due to lower volumes on some older Stryker vehicle programs sort of winding down. And the filings specifically mention the termination of the M10 Booker program as a factor, too.
The light tank program that got canceled? Okay.
Yeah.
So existing programs saw some dips, but the future pipeline looks packed.
That sums it up well.
All right, let's move to our final section, Section 4. This is where things get a bit more complicated. The technology segment and these external risks we hinted at.
Right. Technologies, this segment does a lot of IT services, C5ISR work.
Yep.
That's command, control, computers, communications, cyber, intel, surveillance, reconnaissance. High-tech stuff for the government, mostly.
How did they perform in Q3?
Revenue actually saw a slight dip, down
Okay.
1.6% to $3.3 billion. Management said this was expected due to the timing of certain programs and some older contracts ramping down.
Okay, a small dip, but their order book.
Still incredibly strong. They achieved a record backlog in technologies with a book-to-bill of 1.8x. So, like combat systems, future demand looks very solid.
And this segment is heavily reliant on government spending, right? Especially the military.
Hugely reliant. I mean, just to put a number on it, they generated $7.325 billion in revenue just from the Department of Defense in Q3 alone, across all segments. But technology is a big part of that.
$7.3 billion from DoD.
Yeah.
Which makes them very sensitive to hiccups in Washington.
Exactly. And a big hiccup happened right after the quarter ended.
The government shutdown.
Yep. The sources note the U.S. government has been shut down since October 1st, 2025. Congress couldn't pass a funding bill or a continuing resolution. That's a major headache for contractors like GD.
How are they responding if the government isn't paying its bills on time?
Well, anticipating potential delays in payments from government customers during a shutdown, GD took action after the quarter closed. They issued commercial paper.
So borrowing short-term money commercially.
Exactly, to bolster their liquidity. It's basically a hedge, making sure they have cash on hand to cover payroll and operating costs while they wait for the government funding situation to get resolved. Smart move, but it shows the disruption.
And it's not just the shutdown, right? There were mentions of other government actions impacting them, efficiency drives.
Yes. The filings refer to government efficiency initiatives, sometimes dubbed DOGE actions for Department of Government Efficiency, though that seems a bit informal for a filing.
Maybe. But what's the impact?
It's led to some federal staff reductions, hiring freezes, more budget scrutiny. And for GD, this is translated into delays in getting some contracts awarded and even some contract terminations, especially in their IT services areas, as agencies look to cut costs.
Okay, so budget pressures and political uncertainty are definitely headwinds. But there's one more big risk factor we need to discuss. The legal one.
Yes. The elephant in the courtroom, as they say. There is a significant legal proceeding mentioned in the filings that could potentially be a very big deal.
What's the case about?
It's a putative class action lawsuit, basically an antitrust claim. It alleges that GD and some other major defense contractors conspired not to hire naval architects and marine engineers away from each other, a sort of no-poach agreement.
Okay, anti-competitive hiring practices and the time frame.
The allegation is that this conspiracy went on potentially since the year 2000.
Wow, since 2000. That's nearly a quarter century of alleged activity. What's the status now?
Well, the case was initially dismissed by a lower court. But then the Court of Appeals, the Fourth Circuit, reversed that dismissal and sent it back down to the district court to proceed.
No, it's active again.
Very much so. And the defendants, including GD, are fighting it vigorously. They filed a petition asking the U.S. Supreme Court to review the case that's called a writ of certiorari back on September 11th, 2025. They want the highest court to step in.
And the way GD described the risk in their filing, it sounded pretty serious.
It did. The language was stark. Management stated explicitly that they're unable to estimate the potential loss right now.
They can't put a number on it.
Nope. But they added that if the outcome goes against them, it could have and this is the key phrase, a material impact on the company's results, financial condition, and cash flows.
Material impact. When a company uses those words about a lawsuit where they can't estimate the loss, that's a significant warning flag for anyone watching the stock.
It absolutely is. It signals a potentially very large, unquantifiable financial risk hanging over them.
Okay, so let's try to wrap this deep dive up. General Dynamics, Q3 2025. On one side, just a stellar operational quarter.
Totally. Firing on all cylinders.
We saw that dual strength, right?
Yeah.
You had Aerospace booming, the G800 delivered, the G300 announced, great margins, really strong commercial demand.
Yep, hitting records there.
And then you combine that with just massive, sustained, long-term demand across the defense businesses, marine, combat systems, even technologies, despite the slight dip. That huge $109.9 billion backlog tells that story.
Absolutely. They're executing beautifully, generating that incredible cash flow, nearly double their net earnings. Their strategy seems perfectly aligned with both luxury demand and global defense spending trends. Operationally, it looks fantastic.
It's a big but. Here's the final thought, the thing for you, the listener, to really chew on. Despite hitting all these record metrics, despite having almost $170 billion in potential work lined up, a single factor, something completely outside their programs and operations, like how that big antitrust lawsuit turns out, or just how long this government shutdown drags on, could potentially overshadow all that fantastic performance.
It really crystallizes the tension, doesn't it? It forces you to ask, what does it mean for a huge, successful company like GD when its operational excellence can potentially be held hostage? Hostage to political gridlock in Washington, or hostage to HR-related litigation about alleged actions from decades ago?
Yeah.
Both of those risks are essentially unquantifiable right now, but the company itself flags them as potentially material. So how do you, as an observer or investor, factor that kind of political and legal volatility into the value of a company whose core business otherwise looks almost perfect?
That's the multi-billion-dollar question, isn't it? Especially with defense contracts stretching out for decades. A lot to think about there. That was a deep dive into General Dynamics Q3 2025. We'll see you next time.